Good day, fellow investors. Today we'll discuss automated investing, not thinking about investing, and thinking about investing. There was this great comment from Harvey King, a millionaire from Australia, and he disagrees with me about the risk and reward of investing in the S&P 500, and that we always complicate investing. That's why most people don't make good investors. His kids are better than most adults. They have automated investment plans, and that makes them calm and relaxed. Most are greedy, selfish, unhealthy, and impatient. Also, they're highly caffeinated, so essentially drugged out. Kids are the opposite. See what I mean? Who's going to be the better investor? And then also this comment by Milo discussing, wouldn't it just be easier to buy Berkshire shares, and what is the advantage of follow value investing with 7 advice there. Now, the topic therefore is thinking versus not thinking about investment, and my answer here is price paid. That's it. Now, if you go to Berkshire shareholder letter 1985 here, this is what Warren Buffett says about it, and most institutional investors in the early 70s and now also regarded business value as only minor relevance when they were deciding the prices at which they would buy or sell. This now seems hard to believe, but also now in 2019 seems hard to believe. However, these institutions were under the spell of academics as prestigious business schools who were preaching a newly fashioned theory. The stock market was totally efficient, and therefore calculations of business value, and even thought itself, were of no importance in investment activities. We are enormously indebted to those academics. What could be more advantageous in an intellectual contest, whether it be bridge, chess, or stock selection, than to have opponents who have been taught that thinking is a waste of energy? I think that automated investments have a place, but I think it's wrong to teach kids not to think. Let's just discuss automated investments. Don't think, just put your money, and just to warn you here, I think it's good. You have bad, you have good, and you have better. So automated investments are somewhere in the middle. Good, as Harvey King, he's not wrong with what he's saying, but I'm just going to add a touch there, which is price paid. Because if you just buy stocks, you buy when those are up, you buy when those are down, and over time you accumulate your wealth, and you are happy when those go down, you buy more automatically, and at the end you end up with a good portfolio, good investing. Completely agree with our millionaire Australian Harvey King. You are spot on. That's it. Right. Good, alright? And even if there is an index that doesn't go anywhere as the Australian index, they have these great franked dividends, so you compound there, you reinvest more automatically, and you again get a good portfolio. Similarly, the Dutch index didn't do much over 25 years, but those that bought here automatically have a good portfolio. So not thinking, good return. Nothing wrong with that. However, we must also understand that not thinking might lead to no return for 15 years. Depending on when you started, how it will look next, we don't know. But if you have no return for 10-15 years, that is very, very demoralizing. And yes, it's still something, but it's like saving in a bank. You will have a good return, but not a better return. And especially now, with the dividend yield of the S&P 500 at 1.32%. Please tell me in the comments what's the dividend yield in Australia, likely 4 or 5%, I hope. And if the yield goes back to 4% by 2030, that's with some dividend growth, that's still 50% down for the index. And then you never know whether it will keep going up or not, but 50% down on your savings that you automatically invested is also a possibility from the current price level. And yes, it worked amazingly over time. Over the last 40 years, the S&P 500 is up 30-40 times. Some other indexes are not, but when it comes to investing, you can have, I trade, I lose money by trading, automatically good, so it's better than trading, that's definitely so, but can I get a better return is my question, and for those that are looking for better returns, that's why we have this channel. Now if I buy automatically the S&P 500, 7% of my purchase goes to Nvidia, which is trading at, what is this, 30 times revenues. And now let's just take this in comparison to thinking, 30 times revenues, changing the world, versus something that is more stable and is trading at 30 times earnings, like Google. So just to compare the two in a thinking way. Okay, we don't know which one will lead to better returns, but which one will lead to more guaranteed returns? This, with a P ratio of 100, that's an earnings yield of 1% that is completely reinvested into future growth, or this with a 3% yield that is all bought back stocks, all returned to shareholders. So it's hard to compare. Okay, 1%, 3%. If you can find something at 10% by looking, by thinking, you can get a better return. But my message here is you can always compare if you think, see about the risk and reward of the current situation, and then see how it fits your financial life. That's the key. That's the step up. You start thinking about, you take advantage of opportunities when there is less risk, and you avoid the risky situations. That makes me sleep better, and I would not sleep better if it was all automated. Because if you have here, not thinking, you get 1-3% dividend yield, and you compare it to 4.3% from the US Treasury, that is no risk. That is, when you start thinking, you think about the price paid for the reward received. And there I want to discuss Berkshire here. Yes, it is a great investment. You will do good by investing in Berkshire, but the market capitalization is 887 billion, their earnings around 44 billion, thus a P ratio of 20 plus some growth, okay? And now, I don't know where will the stock go in the future. Yes, Buffett will do great returns, 5% plus some growth. Likely over the long term they will be 8% returns. But even Buffett is not buying his stock, his cash pile is going higher because he thinks that this price is too expensive for Berkshire. And that's all I'm saying. If you think you have options, and I prefer to have options whatever I do in life. Yes, I will miss out on some huge runs, but I will also miss out on some huge bubbles. That's investing for me. I prefer to teach kids to think for themselves because you never know what will be the environment 10-15 years from now. Maybe the Fed will not print money, the ECB will not print money anymore, situation will be different, and you will have to start thinking. I'm sure, Harvey, that you made your millions by thinking. So teach your kids business thinking. I'm sure you're doing that. And invest in your business. You will have much better returns than in the S&P 500.